Hey my fellow brethren, welcome back to the channel. Today we're switching it up and we're doing a finance video today. So in this finance video, I'm going to show you guys a strategy that I like to use, that I've been using for maybe 4 or 5 months now, and I can really see the upside. So let's get right into it. Some of you guys, if you're into stock trading, will know this is called the wheel strategy. For those of you who don't know, I'm going to explain that now, and I'm going to give you guys the upsides and the downsides of using this strategy. So one reason you'd want to use this strategy is if you're the type of person to hold on to a stock indefinitely. If you buy the stock and you get attached to it and you just never sell it, right? So that could be an issue in and of itself if you're not taking your profits when you should. So this strategy here, it's really good because it allows you to predetermine when to sell and when to buy, so that you're not having a fear of missing out and holding on to the stock and not collecting the profits when you should. For example, if you hold on to, I'll give you a personal example, right? Because I'm that type of person. So I would hold on to a stock for 4 or 5 years, right? Certain ones, not all of them are going to be like this, but it is a pretty common scenario for a couple of them. So I would hold on to a stock for 4 years and it would just bounce up and down in its given range, and I would always buy more stock and average my cost lower when it did dip. And that was a way I could kind of, rationalize not selling the stock. And that's a pretty good idea as well, except for it's making you use all your outside resources without fully compounding the money you're making in your portfolio, if you know what I mean. I just want to say before we break down the strategy that this strategy will net you guys about 4 to 9% per month, depending on how long you set your contracts out to. So that's why you want to make usually a monthly long contract or bi-weekly, just so that's like the sweet spot of your time decay and your premiums, and yeah, all that combined, that'll get you, let's say you're an average of 5% a month, that's 60% gain a year, guys. So if you're working with an account like, let's say $11,000, or let's just round down to $10,000, you're going to be making 60% of $10,000 a year with this strategy. And $10,000, I don't know where you guys are at in life, but if you just have a basic 9 to 5 and you save, guys, in a couple of years, you can have $20,000 to $30,000. I mean, lowballing if depending on how you are in life. And then from there, you're cooking, guys, making 60% of $30,000, and all it took you was a couple of years of saving. And you start compounding and compounding this strategy, and pretty soon, I just wanted to give you guys an idea that this strategy scales enormously. So let's say you finally get $100,000, to your name, and you're making 60% of $100,000, guys. That's beautiful. Even that's medium, right? And you can go super safe with it, right? If that sounds too good to be true, let's say it is, fine. You can make 4%, right? 3%, and you're still looking beautifully on your way to retiring early if you have $100,000 to do that strategy with. And I know you guys are going to say, like, who has $100,000 to? I'm just saying that could be 30-year-old you, right? Or 40-year-old you. That doesn't have to be 18-year-old you or 20-year-old you, right? I'm 27 and I'm working with, basically about $12,000. And the strategy that I'm using, right, is only taking $5,000. The rest is just in regular stocks and crypto. So I'm still kind of, far out. I'm with you guys, right? I'm starting from scratch, basically. Once we get this strategy going, I just wanted to tell you guys that it can be scaled up insanely. And let's say 5%, right? You're making 5% of $100,000 a month. What is that? That's $5,000 a month, guys. That's money you can quit your job with, right? That's $5,000 a month passively at home, right? Now there's one kicker, right? There's taxes we have to worry about. So I don't even know. I haven't even gotten to that point yet, but my research is, I think 40%. Is the tax rate, or depending on how much money and income you have, it might be taxed like that as well. But worst case scenario, I believe, is like 40%. So that sucks, but that's what you're going to have to do regardless of any type of stock trading. So anyways, 40% of 5,000 is roughly like couple $1,000s, right? So even though we're making $5,000 a month, pure profit, we might only be making $3,000 a month. And that's with $100,000 capital, right? So now you're thinking, that sounds terrible, right? You're only getting $3,000 from $100,000. Well, don't think of it like that. Think about it, $36,000 a year for nothing. How's that? That sounds way better, right? Another thing is that taxes only has to be paid at the end of the year. So you're still making $5,000. So you're still making $60,000 a year, right? And that can be used to grow your $100,000 liquid capital collateral account, because that's what you need, to do the strategy. All that money needs to be liquid so it can become collateral in the event that you buy stocks. But with that $60,000, right, you can use that as collateral and you still gain more and more profit. So by halfway through the year, you're working with a $130,000 account. And now instead of making $5,000, you're making, let's say, $5,500. And then at the back end of the year, you're working with a $160,000 account and you're making $5,600 a year or something, or not a year, $5,600 a month. So as you can see, it scales quickly as long as you just save your money, you have patience, and you do what I'm going to tell you in this video. And don't forget to pay your taxes. All right, and all glory to God whenever you do become successful in this. So let's get into the video. All right, so we jumped over to Uber here, and we're going to explain to you guys the strategy, right? So selling calls and puts. Calls is you think the stock's going to go up. Puts is you think the stock's going to go down. So we're selling the right for these guys to gamble basically with their money, right? So we're not going to look at it buying. Buying is no good. It is just gambling with extra steps. We're going to look at selling, which is slow and consistent profits over time. So here is the tab that shows you the dates. This is how long your contract can be for the option, and options deal in hundreds of shares at a time. You can only do one option at 100 shares, right? They're linked to each other. So if you do two options, that's 200 shares. So for this strategy, right, you're going to want a little bit of a higher liquid capital. And it can be scaled increasingly. The numbers look better and better the more money you have, right? So the first part of the wheel strategy is the put side. So we're going to be selling puts, right? So let me explain all this to you guys real quick so it makes sense. The strike price, that is the price at which the option will exercise and force you to buy 100 shares, right? So the reason you need that high liquid capital is because when you activate the option, it holds that much money as collateral until the expiration date. Because if it does go below the strike price that you agree upon, it will buy the stock at that price. So let's see on how that could be a very, very, very good thing and why we use the strategy. So you only want to do this strategy with a stock that you like, right? And that you would want to own. So what price are you comfortable paying for Uber is what we're going to be saying when we're looking at these strike prices. If you're super bullish on Uber, you might even just want to buy the stock, just outright without doing the strategy. But if you can wait, if you have patience and money, that is the two things you need for this strategy, patience and money. So let's see how this works out for us, right? So we have these strike prices. The current price is $95. So I'm saying I want to buy Uber at a discount, because who doesn't want to buy stock at a discounted price? So let's say I want to buy Uber at $93, right? That's a couple dollars off the current price right now. So that'd be awesome if I could buy it a couple dollars cheaper, right? So we're going to click on this and we're going to look at one thing here, guys. You can do your research on the rest of these datas and stats here, but I don't have time for that. We're just going to be checking out the only thing that applies to this strategy, which is implied volatility and time decay, but that's not too important. So just implied volatility here. This is 40% implied volatility, which is kind of average. It's not that good, but that is mainly because Uber has been on a uptick, right? So depending on if the stock's trading up or down, you're going to get better looking numbers. So anyways, and the volatility is going to change obviously, but even if the volatility is still the same, the numbers here, the bid price can go up or down, in your favor, even though the volatility is still around the same amount. It just depends on if the stock is trending up or trending down. And the reason that matters is because this bid price here, let me close this. The bid price here, that is what you're going to be getting paid right off the bat to do this strategy. So this is the money that we're going to be making, which is why I like this strategy, because earlier I said it forces you to sell and buy at predetermined areas, so you're not holding onto your stock too long, right? So that you can start compounding the profits that you make in your portfolio. So with the higher implied volatility comes higher prices, higher premiums that you're going to be getting paid. So that's where the patience comes in, and your high capital. You want to have patience. You don't want to just chase the biggest number here, because you will get burned, okay? So let's say, like I said, I am willing to buy at $93. That's a good discount. If you think Uber is going to skyrocket, you can go all the way up to right under the current price, which is $95, and you get a nice higher premium. So let's just go ahead and see what that looks like, right? Because we think, let's say Uber is going to go at $100. So this is beautiful. This is what we want to see. So at $100, if it goes up to $100, nothing happens. You just collect the $78, depending on the price, or the date, I mean. At the end of expiration, you collect that $78, right? If it goes down below your strike price, which is $95, that's what we agreed upon, it will force you to buy 100 shares of the stock. Here you can see that price changing, how it says expected profit and loss in the numbers right here. So if it only goes up, you're going to get no more than the amount you already agreed upon, which is $78 credit. That's one of the cons of the strategy. You miss out on unrealized profits, right? Which is kind of like silly. That's like gambling and, losing the lottery, and then someone else wins it. And you're like, oh, if I only picked those numbers, I would have won that much money. So you don't, or if you're at a casino, and you're gambling, you don't look at money that you could have won as money that you lost. So if you can see that, then this is a good strategy for you. If you can't see that, then you might not like the strategy. So like I said, if it goes above $95, you keep the profit that you already agreed upon. It doesn't go any higher than that, which can suck, if the stock skyrockets. But if the stock goes down, then you can see your expected profit and loss start to change, right? That's because the amount of money that they gave you is off the top. No matter what, it already is in your bank account. So technically at $94 you break even, because it already paid you the $75. So if it goes past that, that's when you're going to start seeing negatives. Now this isn't anything to worry about, right? So when you start seeing negatives here, your max profit and loss is if the stock literally goes bankrupt. That's never going to happen if you just choose quality stocks. It's not hard to do. So, but if you see the negatives, right, and it's, goes down to like 94.09 and you're negative 15, negative 20, that's not the end of the world. It's just, like I said, it's going to exercise the option just like it would here. It would force you to buy 100 shares at the current price of $95, is it? I think if you end up buying it, if it does end up getting exercised, it'll show you this price here as the average price you buy the shares at, right? So it'll show you this price here at $94.24, and it'll show you just 100 shares that you bought at $94. So if it's lower, then it just shows you that you bought 100 shares and you're down money right now. And that's not the end of the world, because you don't have to sell those shares. So the money isn't lost. So that's where the other side of the wheel strategy comes in. This is the worst case scenario, by the way, guys. Best case scenario, depending on how you want to play it, you just rinse and repeat the selling put options, and it keeps going up here. You don't ever get assigned, right? But one of the better strategies is to pick a stock that may, or a price range that may get assigned, very, very on the edge of getting assigned. If that happens, you collect as much profit as you can, like let's say $70, right? It'll be like right here, and it'll still make you buy the stock. So now you've collected the $70 and you've bought the stock at a discount, and now you can move on to the other side of the strategy. So we're going to go ahead and show you guys that now. So the other side of the strategy is selling calls. Now you can only sell calls when you have 100 shares of a stock, right? All right, so here's my current selling call option. Now this might look bad to you guys just because for some reason right, this option expires tomorrow, right? And for some reason, this thing wanted to go up 13% today. So this is going to be one of your worst case scenario options, right? But let's see how that looks, right? Worst case scenario, for some reason, is because I created a sell call option, which means I'm going to sell. Let me pull up these options real quick. So here is my options. It shows 2, right? So I did 2 of these options. That's 200 shares at $7. So on the sell call side of things, the strike price here is the price that it is going to sell your shares at. The puts was the price that it's going to buy the shares at. The selling call strike price is the price that it is going to sell your shares at, right? So whenever you're doing selling calls, you don't want to activate a contract that's going to make you sell your stock at a loss, right? So you want to look into the stock here itself, and we're going to see that I have my average cost of this is $6.37. So now when we go to make a call, as you can see down here, I set it at 7, right? So that means I'm going to collect a little bit of money from the stock itself going up, and I'm going to collect the premium that this pays me for activating the contract. So that's why that's a double dip in a way, right? And the reason this looks terrible is because I don't make any more money after $7 because I'm agreeing to sell this stock at $7, right? And as you can see, it's at $8.30 now. So that's $130 times 2 because that's 200 shares. So that's $260 I just lost doing that. And who knows, I still have a day until tomorrow until this expires. So it's up 13% for some weird reason, man. It really kind of sucks. But that's money that is in my imagination, right? Because you only want to set these strikes at things you're comfortable with. So I was comfortable with selling this stock at $7 because I paid $6.37 for it. I thought $7 was a good idea. And, it kind of was until today, basically. This was a 3-week play. So the last 3 weeks, it's just been staying right at $7. That's beautiful. That's exactly what we want because that means we're not missing out on any money. And if it goes under $7, we keep the premium that it paid us and we keep the shares, right? So, but right now, yeah, it's a little high, a little sucky. But like I said, imaginary money because I basically pre-sold the stock at $7. So you're not going to sell your stock and then keep watching and see how high it goes and then just feel bad, right? So anyways, let's get into the option side of things and I'll show you a little bit more of this call before we close this video down. So make sure you're on the selling or on the call side. You do the sell put option, right? And let's say it tanks. So now you are assigned 100 shares of a stock and you are losing, let's say, like $100 on it right now. So you want to find your average price that you paid, right? In this instance, that was $6.37 for it. And you want to no more or no less set that strike call at that price so that you know for a fact if anything was to happen, you would break even on the stock and collect the premium from this. Therefore, you would be still coming out a little bit positive. Even better plays depending on how much the premium looks, right? You always have to balance the risk versus reward, the money versus the wait time. So this is all on one day basically. If you push this out, all this numbers are going to look way better, right? So anyways, yeah, you always want to pick the strike price at above what your break-even price is on the option or on the stock so that you're not losing money ever. And if you want to get risky, you can do right under that, and hopefully your option call will expire before it reaches that target price and forces you to sell. So yeah, guys, that's basically the strategy. I hope you guys can see the vision. Maybe I didn't explain it too well, but I think I did a good enough job. If you guys have any questions, let me know. There is one more layer of this, the ability to roll your options out. I'll briefly go over it just so you guys have an idea in your head that you can go and maybe do some more research yourself. But rolling options is the ability that the Robinhood gives you and other stockbrokers. They give you the ability to change your expiration date, right? For instance, I did a sell call once under my break-even point. So that's a worst case scenario. So now I was like, you know what, I got to get out of this option. I have to move my expiration date or I have to move my strike price higher. But yeah, just look up rolling options. That's a whole separate video, guys. That'll give you the second layer of control over this strategy, guys. Well, thanks for sticking around, guys. We're going to end this video with a little lifting of the soul through Jesus Christ. Proverbs 13:11, dishonest money dwindles away, but whoever gathers money little by little makes it grow. So that's what we're doing here today, guys. I want to spread the wealth and knowledge that I have, what little knowledge I have, with everybody around so that they themselves can uplift themselves and have a successful life. And I just want to do what I can to give back to the world through Jesus Christ. So that's going to be the end of the video, guys. Thanks for watching. Don't forget to subscribe.